My next guest recently initiated coverage on 8 of these funds, but he's not necessarily a buyer of all of them. Joining me now is Jared Woodard, investment and ETF strategist at BofA Securities. Jared, welcome. You've done the hard work for a lot of people here. How do we separate is it the weed, the what from the chaff? The wheat from the chaff, yeah.
That's right. That's right. I'm glad to be with you because the differences among these funds can be pretty dramatic. You have everything from pure play concentrated funds, BOTZ is an example of fund we like in that category, versus other funds that are much more diverse that include, companies that you might think have absolutely nothing to do with artificial intelligence or new technology. Doing that work under the hood, knowing what you own is always good advice, but it's especially good advice with a theme that still is vaguely defined in some ways as artificial intelligence.
Yeah. So vaguely defined so can we get specific? Like, I feel bad sometimes asking you to call out people who might be, or maybe we'll just call out the best. How do you want to do this?
Well, I think there are some really attractive funds that have defined their universe well and have strong, risk-adjusted returns with good fundamentals. Looking at the coverage across BofA analysts, we incorporate those stock views into our ETF ratings. And 3 funds that we do like include AIQ. Another fund, BOTZ, I mentioned. Another fund is TECB. 2 of those are from Global X, 1 from iShares. And these are all ETFs that are focused on artificial intelligence, but have defined their universe of coverage in a way that has a plausible set of stocks. And we think that's going to be incredibly important because as this theme develops, as the hardware and software becomes more advanced, you want to be focused in companies that are truly participating in this market and aren't just shouting it out on earnings calls or making some nominal investment just so they can say that they're participating in artificial intelligence.
Absolutely. So the ones that you want to avoid then are those who might include a whole bunch of names that aren't really AI. It kind of reminds me of the SoftBank story, unfortunately. A whole bunch of AI names or companies that have mentioned AI but aren't really true innovators and leaders in the space. Do we want to give any examples of that, or just kind of what would you tell people to be on the lookout for?
Well, I think the greatest thing to be on the lookout for, the risks involved here are pretty substantial. I mean, I think this is a very attractive long-term investment theme, but we expect a lot of volatility, and we actually have a relatively overall neutral view on the category as a whole. One thing investors might not know is that the average stock in these AI ETFs, 1/3 of the stocks, I should say, are unprofitable today. That's double the rate of the unprofitable stocks in the NASDAQ 100. Many of these funds are trading at extreme valuations. The overall average for these ETFs is trading at 31 times earnings. Again, double many of the familiar stock indexes people are watching. So you're paying a really high price for some firms that many of which have yet to show profits on the hopes that this long-term theme will play out. We would expect that there's going to be a lot more volatility as some market leaders emerge, and even investors who want to get involved today should be prepared to dollar cost average in over time.
Yeah, so AIQ, you mentioned there's a 63% overlap with BofA's thematic AI stocks, so you like that. TECB, you mentioned bots, you say is good, best for pure play exposure. Further down the list, XT, ROBT, GIN, IRBO, DTEC, these start to have less and less overlap with what you guys have identified as the real AI winners. Is that right?
That's exactly right. Either they have less exposure to the names that our equity analysts like, they have less exposure to the AI theme overall, as our team has identified, or both. And some of those have greater expenses, have had lagging returns, other inputs to our model. Looking at all these measures in a composite way gives us a total output score and gives us more confidence that we can invest in the funds that are likely to track this theme most closely in the future.
So which one would be the best short? Would it be the one that has the most pure play if you think this whole trend is going to reset, or would it be the one that has the least to do and kind of maybe some of the lower quality ones seem to overlap more with the hype than the reality?
If you're a skeptic about artificial intelligence, and I think there's some really interesting arguments to that view, we wrote a report about that this week. If you think there's going to be a marginal contributor to productivity, then our advice is to invest in the firms across the whole economy that will be able to take advantage of AI in their own business to become more profitable on their own, not necessarily the hardware and software firms. So I think in other words, I think artificial intelligence becomes almost a kind of binary bet. If you're a true believer, if you think this will be as transformational as electricity or computing or the steam engine, by all means get involved. If you're a bit more cautious, I think you can invest a little bit today, but also be prepared to buy the winners, the industry leaders across the broader economy. And if those risks do emerge that I mentioned around valuation and profits, then I think that the pure play ETFs and the stocks in those funds will also be the ones the most at risk.